It's important for investors, lenders, stockholders, and others to be able to accurately evaluate the financial fitness of a corporation. It's also important to evaluate changes to the corporation's financial status over time and to be able to compare the financial metrics to other companies. For instance, we may want to evaluate a corporation's financial performance versus others in the same industry. In order to do that with confidence, we need to be sure that financial reporting for all corporations are accurate and reflect the consistent application of the appropriate accounting rules. There are a number of governmental and professional organizations that provide guidelines for accounting rules, such as FASB or FASB, the Federal Accounting Standards Board, and IASB, the International Accounting Standards Board. An example of the guidelines would be Generally Accepted Accounting Principles, or GAAP. We'll be using GAAP as our common language since this is a U.S. standard, while realizing that the standards can differ internationally. Under GAAP, all publicly traded corporations and private companies that produce audited financial statements must follow GAAP guidelines. By following these guidelines, investors, lenders, analysts, governmental agencies, and anyone else involved in evaluating a corporation's financial health can be assured that the financial statements reflect accurate and consistent accounting. As a real estate professional, it's important for us to understand the basics of financial statements, and in particular, how real estate, whether owned or leased, is reflected on the financial statements. There are three types of financial statements. The balance sheet, which is a snapshot of a company's assets, liabilities, equity, and footnotes at a point in time. The income statement, which reflects a company's revenue, expenses, and net income. And the cash flow statement, which describes the sources and uses of cash flowing into and out of the company. For publicly traded corporations, these reports are published with the Securities and Exchange Commission on an annual basis in what is known as a 10-K filing, or on a quarterly update known as a 10-Q. In addition to the standard reporting times, a company is often required to report immediately new information that has an impact on the company's statements. Some of those requirements, as we shall see, are based on real estate decisions. We're going to primarily concern ourselves with the balance sheet and the income statement and how real estate and real estate transactions are reflected on those statements. There are also some special considerations impacting financial statements that users must keep in mind when undertaking real estate decisions. The type and even the timing of those decisions can have a major impact on how much is reported. Real estate that is owned is treated very differently than real estate occupied under a typical lease called an operating lease. On the balance sheet, real estate that is owned is shown as an asset, and if financing is involved, the debt will appear as a liability. Cost recovery and loan cost or points are also impacted on the asset side of the balance sheet. Real estate that is owned also impacts the income statement. Cost recovery taken each year is shown as an expense. If financing was used to purchase the asset, then the amount of interest paid servicing the debt is also shown as an expense. Finally, if loan costs or points were paid to acquire the financing, then a portion of those costs can be expensed each year on a straight line basis. How financial statements are impacted when real estate is occupied under a lease agreement is dependent upon whether the lease is considered an operating lease or a capital lease. The explanation for capital lease versus operating lease is complicated, so we're going to leave that detail for a separate session. On the income statement, operating lease expenses are reflected as a level net rent over the term of the lease, not as how it's shown on the lease document. Specifically, the average annual net rent, that is net of operating expenses, is shown as an expense for every year on the lease term. As an example, a triple net lease negotiated with free rent period up front, followed by a base rent that contains scheduled bumps in the rate each year, would be averaged to a single average flat rent expense, and that amount would be reflected on the income statement for each year of the lease. Now, there are a couple of additional special considerations when dealing with how occupancy costs are accounted for in the financial reporting world. One of these deals with whether the real estate transaction results in a gain or a loss. In general, you must report bad news or a loss as soon as you know it, and you only report good news like a revenue gain or a profit, for instance on a sublease, when you actually benefit from it. Finally, it's important to note that the world of financial reporting is constantly changing. CCIM should always partner with a licensed accounting professional to make sure that the principles they're using are still valid and haven't changed. The simple fact that a real estate practitioner is aware of these special considerations when working with a user sets them apart from the rest of the industry.